Good morning, ladies and gentlemen, and welcome to the ELECTRA Private Equity PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard and will notify you by email when they are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll, and I'm sure the company would be most grateful for your participation. And I'd now like to hand over to Gavin Mason, Chief Financial and Operating Officer. Good morning, sir.
Hello, good morning, and welcome everyone to this presentation of the interim results of ELECTRA for the period to 30th of September, and also an update on the proposed transaction to convert ELECTRA into Unbound Group PLC going forward and relist on AIM. I'm joined today by Ian Watson, the Chief Executive Officer of Hotter Shoes, who will become the Chief Executive of Unbound Group going forward, and also Dan Lampard, the Chief Financial Officer of Hotter, who will become the CFO of Unbound going forward. Unfortunately, Dan's having some camera issues, but he's sitting about 3 feet from Ian and will be able to to participate as intended. We are, as I said, I shall give an update on the results and the proposed transaction, and then I'll hand over to Ian and Dan to take you through the Hotter business and our plans for Unbound going forward. I think I would start by just reflecting the quote that our chairman Neil Johnson made in the interim report that we published yesterday. I think to summarize where we are from a strategic perspective, we're now entering the culmination of 5 years of activity that has seen us return more than double the starting market capitalization to shareholders. This following the demerger of Hostmore, this leaves us largely with Hotter Shoes as our main corporate investment. And like TGI Fridays and Hostmore, Hotter is too good a business for us to sell at low value for cash. And as such, working with Ian Watson, we've developed the Unbound Strategy, which we believe gives an opportunity for significant value creation going forward, developing on the profitable base that we already have in Hotter. To this end, in order to realize this value, we'll shortly be commencing the formal process that will move the company, the same company, ELECTRA Private Equity PLC, will be renamed Unbound Group PLC and will move from the main FTSE market and be admitted to listing on AIM. This transaction is subject to shareholder approval, but we anticipate that the transaction will complete early in the first quarter of 2022. When that change occurs, the current executive team of ELECTRA, which is Executive Chairman Neil Johnson and myself, the Chief Financial and Operating Officer, will step back to be non-executive directors, and Ian and Dan will step up to become the as I said, the Chief Executive and CFO of the company going forward as Unbound. The Unbound Group will trade and report as a trading company, and after the end of the current financial period, the company will cease to report as an investment company. The current financial period is being extended to the point of the transition to AIM, which, as I said, we anticipate being early in the first quarter of 2022. This slide really summarizes the main things that I've just mentioned, but I would draw your attention to bullets 3 and 4. The interim report, as we reported yesterday, reflects the valuation of portfolio assets held by ELECTRA on a consistent basis with prior prior performance and in line with the international private equity valuation guidelines. This process requires that the valuations, whilst the assets are held within the ELECTRA portfolio, have significant discounts applied to them. And this reflects the fact that these assets in a private equity portfolio are illiquid assets and subject to transaction risk to realise value for shareholders. As such, the enterprise values of both Fridays and Hotter were discounted or have been discounted by 33 to 35% in the core valuations that we've presented in our financial statements. To this end, we've also, and these are the assets that the valuations that are reflected in bullet 3 in the slide that's now up. For illustrative purposes only, we felt it appropriate in the current circumstances also to provide valuations that are on the basis of these discounts being taken out. In both cases, the values that we've arrived at in determining what we consider to be the fair value of Hostmore and ELECTRA are significantly above the current market capitalization of each company. In the case of Hostmore, this is significantly driven by, or the current market capitalization of Hostmore is significantly driven by negative market sentiment following a negative forward-looking statement of a core peer in mid-September, whose share price has since fallen by 35%. We are extremely confident in the Hostmore business. It's currently trading strongly, and its core activity, its current activities, TGI Fridays and 63rd and First, are both performing strongly, and we consider that the Hostmore Group will develop profitably and strongly further and grow market capitalization above the valuations that we've presented today. In the case of ELECTRA, I hope that by giving clarity today over some of the remaining assets that are left in the portfolio, in addition to Hotter, and allowing Ian and Dan to explain the Hotter and Unbound strategies clearly, we will show the extent to which the market is currently undervaluing the ELECTRA business. I'll now move to a financial slide which illustrates on the left hand of the 3 columns presented. This illustrates the principal items in the financial statements as presented yesterday in our interim report. And then in the right hand 2 columns, I've illustrated an allocation of these assets into Hostmore and those left in ELECTRA as Unbound, to illustrate the assets appropriate had the demerger occurred as at 30th September. As indicated, this valuation includes the significant discounts that I mentioned previously, and you'll see that the NAV per share indicated for Unbound is 107 pence per share, or ELECTRA is 107 pence per share, and the valuation for Hostmore is 129.5 pence per share. In both cases, significantly above current market capitalization, as I said. Turning briefly to the illustration of the values with the discounts taken out, these valuations increase to 173.2 pence for ELECTRA and 204.6 pence for Hostmore. And I would note that these values are broadly in line with the consensus from analysts' notes that are currently available. At this point, I'll hand over to Ian and Dan, who will take you through the Hotter and Unbound strategies and hopefully illustrate that why we believe these values are sensible, and indeed we believe that we can develop significant further value going forward.
Hey, thanks very much, Gavin, and good morning, ladies and gents. My name's Ian Watson, as Gavin has explained. So a pleasure to talk to you this morning. I think I'm going to take you through a number of slides, some of which were included in our CMD presentation, which we presented on the 15th of September. If you've not had a chance to view that presentation, you can find it on unboundgroupplc.com. There's a version on there, and there's also a recording on there. So I point you in that direction if you've not seen it before. But again, the majority of it we're going to cover, and with a little bit of an update today. So I joined this business in March 2019. And over the course of the last 2.5 years, the Hotter business, we've been transforming it from a retail-led business, which was driven by store rollout, a real lack of product vision and brand alignment. And the fact that we had an omni-channel strategy was actually driving complexity, not focus, and a business that needed to upskill for a change in model. So we set about that task of putting in a transformation strategy, which you can see there in the middle of the chart, bringing and refocusing our product range back to its core of comfort, repositioning the brand to be firmly around comfort and comfort footwear in a positive light. We started to re-energize the team and drive them to best cost through Lean and Six Sigma techniques. We looked at optimizing our route to our consumer and utilizing people, process, and systems to rejuvenate the business. And as we sit here today, you know, Hotter is a digitally led direct-to-consumer business with a very loyal database. We've repurposed our retail proposition. We now have 17 standalone stores with 7 garden center concessions, all of which are profitable. We have a product range with clear, sustainable competitive advantage, which is anchored back into comfort. The brand re-anchored back into comfort, and we've spent money on technology to aid that consumer shopping experience, and all of which complete with a supply chain which has got flexibility and drives products at best cost. So we've been on a significant transformation here in the business. I'm not going to dwell on the next chart too long. You'll be able to spend some time analyzing it, but this is kind of the chronological effect of what we've been doing. I draw your attention to the COVID period, really, and we took full advantage of the pandemic. We launched in July and June of 2020 our new website, which is completely focused and cloud technology, WebSphere 9, latest headless commerce. We invested heavily in our 3D foot scanning technology. We executed a CVA so that we exited some of our unprofitable store portfolio. And we really relaunched this brand around customized comfort and limitless possibilities, and really redefining comfort as a positive nature. So our products are for people that enable them to do more of what they love, rather than comfort being perceived as something that is somewhat old-fashioned or a period of your life where you're giving up. This is an enabling version of comfort that enables you to do the best, to make the best of every single day. So that's the journey that the business has been on over the last 2.5 years. To give you a financial snapshot, the 6 months to July 2018 versus 6 months to July 2021, we've taken this business from a break-even business to one which is making 10% EBITDA in the first 6 months of the year. I think equally importantly, we've moved our UK direct business from being 35% of our mix to 71% of our mix, and retail down from 45% of our mix to 12% of our mix. At the same time, we've stabilized our US business, returning that to profit. So again, some significant transformation over the last 2.5 years that we're now starting to see paint through into our results. And to give a trading update for the third quarter, so these are unaudited numbers, but you can see the trend in revenue continues. So we've seen 10% or 9.2% growth in revenue over the third quarter. Our third quarter is August, September, October, with continued expansions of our gross margin as we reduce the effects of discounting and manage our inventories much more closely. During this period, we've been hit with some supply chain issues, which have probably suppressed revenue by circa £1 to £1.5 million. So without those supply chain challenges, we would have seen double-digit growth in the revenue line. Quickly, hot off the press, Black Friday update, which is not included in the numbers, but those 4 days over the period, we saw an 11% revenue growth year on year. When we look at some of the data in the market from IMRG in the footwear and apparel space, we've seen that revenue has declined as a benchmark in those categories. So we're very happy with the performance we've seen over Black Friday. If I switch gears and just talk to you very quickly about the comfort market, comfort shoe market, it's over 3.9 billion market size. Consumers, the two things that they're looking for the most, shoe fit and comfort from their purchase criterias. And we're seeing growth in this market. The data here refers to 2018 to 2019. What we've seen during the COVID period is an even further expansion of people requiring comfort type products. Our brand is firmly focused in comfort. So our DNA, comfort, customized comfort, limitless possibilities, which is underpinned by both our behaviors and our product pillars, which all start and end with comfort. And within our product pillars, we have precision fit, tailored comfort, and timeless style. So we're very focused on developing products that fit perfectly, but equally being able to tailor and personalize the offer to your specific type of foot, all encapsulated in this timeless style design that we develop here at Hotter. If I look at our brand awareness and perception, I think we've got a very strong awareness within our business on the left-hand side of the chart. When you go to the right-hand side of the chart, we're perceived to be the #1 against our peer set for brands which create comfort products. So we have a very strong brand awareness and a very strong proposition for our critical to quality elements. Then we start to look at some of our technologies. You'll see on our website, we're now starting to personalize product ranges. So our Cushion Plus technology uses some of is made from a polyurethane compound that returns some of the energy that you put in every stride into the next. It includes some patented technologies such as Infinergy, which is a BASF product, which we incorporate in the product. And with our stability products, we've added lateral support with underfoot feeling, as you can see from the chart on the right-hand side, but with dual density footbeds that enable a product which is slightly more stable for somebody who requires that stability because of their foot shape as they get a little bit older in the next period of their life. And then our product development process. So gone are the days where businesses have a autumn, winter, and a spring, summer season. We're fast moving towards a product development process which has 10 drops per year. So again, we're always bringing something new to our consumer base so that they continue to come back online and into our stores. The key driver of further drops in our product process is that it reduces working capital and therefore minimizes the amount of excess and obsolete that you would have at the end of the season, therefore driving higher gross margins. So that's a whistle-stop look at the comfort market, a little bit of information in our product portfolio. Clearly, you can go to our website, hotter.com, to understand the products in a little bit more detail. If I switch gears and look at our channels of distribution and our consumer base, from the earlier number chart, you saw 71% of our revenues came from direct to consumer. Retail stood at 12% in the first half of this year, our US business at 10%, and digital partnerships and international markets at 7%. So you can see that significant change to being being transformed from this being this retail centric to a digital first business, and you can see that in our mix of business. If we look at if we look at that in a little bit more in our digital business, you can see the UK direct digital revenue growth. And you can see on the right-hand side of the chart, the change in mix. So this is our direct business. How you read that chart, the black bar is digital and the orange bar is analog. So you can see that in full year 21, we had 79% of our revenues in the direct channel came from digital. In the first half of this year, it was slightly lower, 75%. You may ask yourself why. I think it's a pretty straightforward answer. As the pandemic struck, we cut significantly our analog marketing investment. So we didn't send any catalogs to our consumers. We relied on our digital business. As we've gone through this financial year, we started to reintroduce some of our analog marketing. So our digital business has continued to grow in a pound note setting, but we've seen a return of sales coming through our analog channels, and that's what you can see in the mix. If I look at our database, and one of our core assets in our business is our database. In the CMD presentation in September, we presented a database of 4.5 million consumers, with an emailable proportion of that of 846,000. If we step to the end of October, there's been some growth in our database to 4.6 million. But more impressively, we've now got over 1 million emails of consumers in our database, which is driven predominantly by our digital focus. So our investment in our footprint technology, which a consumer comes into our stores, they have a full 3D foot scan, they leave us with their email, and we're able to give them specific recommendations of products based on their foot shape and type. So we continue to push digitally, and you can see the progress we've made even from the middle of September. The same with our app. We continue to see growth in our app. Why are apps important? Well, they're important to us because an app user converts at about 2 times more than our website. So on average, our website converts at roughly 3.5%. Our app converts at 7%. And within this now, we're starting to develop our virtual try-on technology, which is in the app. Let me see if this works in the PDF, which I'm pretty sure it won't. And no, it doesn't. So if you go into our CMD presentation on the website, you'll see a demonstration on this slide, which is in the CMD pack. But in effect, what you will see is the lady browsing a pair of shoes on the app. She will then hover the camera over her foot, and she'll be able to see what that pair of shoes looks like through virtual reality. And therefore, again, helping drive conversion up as we sell more products through the app. If I switch gears to retail, so these are some images which come from our latest store in Solihull. So on the left-hand side of the chart, you can see something that's our footprint machine. So people take that 3D foot scan, as we've just talked about. To the far left of that chart, you can see a digital kiosk. So consumers can browse the range online. And therefore, we now have a solution which we've tried and tested where we can roll just this solution into other outlets. So we currently have a trial in the Trafford Centre in Manchester, where we are capturing digital data of consumers. We are able to take orders without having physical inventory on the booth. Equally, there's huge opportunities for us to expand this opportunity into garden centre concessions at a very low working capital rate. In fact, 0 working capital. And we will ship the products directly to the consumer the next working day. Now, I may hear you say, nobody would want to do that. They want to take the shoes with them. Well, actually, as we sit here today, 50% of our retail sales come from consumers who follow this very same logic. The shoes are not in the shoe shop. They go through this process and the shoes are delivered to them the next day. So lots of opportunities for us to continue to expand the Hotter business that way. In summary, the growth strategy around Hotter has been, since my arrival, all around digital, all around continuing to develop this product portfolio and develop a technology differentiated product, driven with the multi-drop strategy. And there's a whole host of other things that you can see on the chart that we continue to do. But that is the cornerstone of what we've been doing at Hotter and what the future strategy for the Hotter brand is. When we started to look at this business, though, and as Gavin said, I think in his opening remarks, we thought this is too good a business to sell in a trade sale. There's so many more opportunities that we can have for it. And this is where the thought process around Unbound came from. And we started to think about Unbound. And again, read this in your leisure. But all of the market drivers, all of the macro drivers are heading in our direction. It's an aging population. There's a high concentration of wealth. Digital literacy is improving significantly. Over 30% of internet users are over 55. Online shopping during the pandemic has driven the over 65 group, grew the most. There's an increasing focus on health and well-being in the old demographic. And from my perspective, I think this is materially underserved online. If you were to Google over 50s or over 55s, you'd be amazed at what comes back your way. It's stereotypical pictures of people on the road to retirement, on the back of a cruise ship, reading a book. That's it. And actually, today's 55-year-old is not the 55-year-old of 20 years ago. And we think there is an empowering way to communicate to this consumer, and there is an area that is wide open for us to take advantage of. That, coupled with 4.6 million people already in our database, which equates to 29% of the female population, I think it's a really compelling space for us to move this business. So in essence, we're going to leverage the Hotter proposition and capabilities in this enabling version of Comfort to tap into broader opportunities by creating a group that understands, connects, and sells to this 55 plus market. But I think understands, connects is the most critical elements of that chart. So in effect, we're going to go from a single branded footwear business to a multi-brand, multi-category group. Now, you may think, well, why and so what? Well, if you study any digital metrics, you would see that a single brand around the footwear and apparel space would probably have a frequency, well, not probably, has a frequency between 0.5 and 1.5. So that means on average, your active customer base are buying between 0.5 and 1.5 of your product per annum. In multi-brand, multi-categories, you see that frequency move to between 3 and 6. Because you've got multiple categories, there's more opportunity for them to come back and buy something else. So again, this is why we think this is a huge opportunity. So our vision really to help people move, feel better, and do more of what they love, like we've talked about. And the mission to do that is developing technologies, product experience, and partnerships rooted in digital excellence and unrivaled insight to give people in their 50s and beyond the comfort and confidence to go further. So some key words in there, particularly around digital excellence and unrivaled insight. And the insight is the key here. So we speak to our consumers on a regular basis. We segment them using state-of-the-art tools in the business. And we understand, through that understanding, we're able to connect. So through that connection, we're able to curate a range of products that this consumer will want to buy, but purely curated for them in the way that we do our research makes it possible for us to do so. So we're going to start with a partner strategy. Okay, so how to read this chart? Let's start at the left-hand side of the chart with core categories. So we thought about this at length and said, okay, the Hotter position and our database position is all around fit or comfort. So we started to look at categories which require elements of both. So we call those our core categories, which would be footwear, apparel, and wellness. And moving forward on our journey, we'll start and look at adjacent categories. That could be gardening. It could be anything based on what our user base does. But gardening, we know, ranks extremely highly within our consumer base. But if we go back to footwear, apparel, and wellness, then we started to say, right, okay, what's our criteria for selecting partner brands? And we said, well, they've got to be relevant. It's got to be relevant for this 55 plus market. It's got to be aspirational. We want these brands to be an aspirational place to come to the unboundgroup.com website. They've got to be a specialist in what they do. So this is a curated range of products. Therefore, they have to be specialists in that category. And equally as important, they've got to be sustainable. They've got to come with strong environmental credentials that, again, will amplify our sustainability story for the Unbound Group. So following on from the CMD, you'll have seen that chart in the CMD. This one you won't have seen. So we mapped over 150 brands against the criteria I've just highlighted. Then we've shortlisted that or long-listed that to 20 brands within footwear and apparel as a starting point. We then did a detailed due diligence process where we looked at audience stats and relevance. We looked at digital prominence. We looked at the strengths of their brands. And most importantly, we then tested those brands with our current database to get their view on what they thought and what they do. And from that, we've developed a specific range. We've got 4 target brands within footwear, and we've got 11 target brands in apparel. So we've chosen categories in which we currently don't have a product offer. So in footwear specifically, so in some areas of outdoor products, specialist sandals in which we don't participate today, and a broader range of wellies and garden type products. Within apparel, our user base is wearing a lot of knitwear. So we've identified knitwear as a key area. They're outdoors a lot, tend to be retired, walking a lot, therefore outdoor products. They spend quite a bit of time at home, so loungewear is important. And certainly in terms of hobbies, yoga and yoga wear and fitness wear comes out very highly. So again, those are the categories that we've looked at. That's where we've developed our partner strategy. We've identified, we've diligenced, we know the consumer wants this curated range, and we're going to start communicating with these target brands in December. In fact, we've already started with 2, had very positive feedback. And then we'll have meetings with them in January. And then we're going to do exactly the same process in wellness. And just to give you a bit of an idea on wellness, we've started to split that out into 5 key categories of fitness, sleep, appearance, mindfulness, and nutrition. 5 key growing areas, which is an enormous sector of the market. So we think with our unique insights and our unique database, we have an opportunity to be able to develop an offer for our consumer base that will not only bring them products that they are looking to see from our business, but equally drive frequency and average transaction values for us as a company. So that's the plan. How the model will work is that it will be a commission-based model, and we will charge our partner brands a commission based on the sales. So there is 0 working capital that we will be required to invest in, and there is therefore minimal risk. In terms of timings, we plan to get those first commercial agreements in place in the first quarter next year and launch and have first revenues in H1 22. We're already building those digital capabilities, and some of the digital capabilities that we have within the Hotter brand today will be able to leverage across the Unbound Group. And then from that, we'll start working on those adjacent markets, which we've talked about. And then in time, as we become more successful and understand, there may be an opportunity for us to develop our own range of apparel, for example, and therefore we'd be able to move away from commission-based margins into margins which were more akin to our fleet in the hotter business. With that said, I think it's time for me to have a break for 2 minutes and have a sip of water. So I'm going to pass on to Dan, who's going to take you through the financials.
Morning, everybody. Thank you, Ian. So I'll give you a quick run through of the hotter financial performance to July 21, the medium-term guidance that we issued back in the CMD day on the 15th of September, which is unchanged, and then an overview of the financial framework for Unbound. So just to give you a bit of context of the performance, I wanted to share the channel revenue performance over the last 2 years. And the most relevant comparative periods being our half year to July 22, so actually our calendar 21 because of our year end being January, compared to H1 20. So as you can see, the D2C online growth at 31% really demonstrates the switch from offline to online, with the overall D2C growth being plus 6% over the 24-month period. The offline consumer revenue being serviced through our contact centre, which is a scalable and flexible resource model, but it also provides a key touch point to our customers. And our retail performance, as you can see, has been impacted by COVID during the first half of this year. However, as Ian said, our reduced estate is profitable and we've seen very strong performance in Q3. We've consciously minimised our investment in the US to ensure we're achieving a break-even position, and we're exploring now how we can scale in the future. Our digital partnerships are growing, and as we increase the number of partners that we work with, our H2 21 to H1 22 drop being caused by the Debenhams closure was now recovering under Boohoo ownership, and we've recently started to trade with John Lewis, and we see this as a key growing area in the future. And then finally, our wholesale and other represents a number of independents, which have been also impacted by the pandemic, similar to our retail estate. We see this as a minimal growth in the future as we focus more around our digital partnerships. So in terms of the P&L and the bottom line, you can clearly see the success of the execution of the strategy. From H1 22 to H1 20, we've had a 27% increase in EBIT and a doubling of the margin over the last 24 months. Gross profit is starting to return to pre-pandemic levels, and we've seen significant improvements in our gross profit margin over the last 12 months. As Ian showed earlier, our Q3 results showing that continuing. In terms of the cost base, our semi-variable costs as a percentage of revenue have increased as the change of mix from offline to online has occurred, as this has been driven from the increased marketing costs as a result of the switch to digital. However, with the continued database growth, we've seen a positive downward trajectory in this cost as a percentage of revenue. And finally, as you can see, we've had a significant fixed cost reduction, and this has been largely driven from the closure of the unprofitable retail outlets and restructuring of the cost base. So overall, the last 2 years have been incredibly successful as we've executed upon the strategy. Looking ahead now to the medium-term guidance, again, this is consistent with what we shared back in the middle of September and is remaining unchanged. So our UK direct-to-consumer online, we see mid-teen annual growth, our offline mid-single-digit annual growth, and retail, as I've said, recovering to FY20 levels by the end of our financial year 23 and stabilising. Our US direct-to-consumer, as I've said, we're undergoing a strategic review, and the short term will be maintained at current levels, which is a break-even business. Our digital partnerships growing at double-digit and wholesale being maintained. As I've said, our gross margin being approximately 2% above our pre-COVID levels from next year as the COVID disruption diminishes and we see the positive impact of the differentiated product that Ian referred to driving the margin. And overall, from an EBIT margin perspective, to reach mid-teen over the medium term. And from a cash conversion, our operating cash flow pre-exceptional has been in line with EBITDA. And our capital expenditure being relatively stable at 2.5 million with no significant one-offs anticipated, and medium-term with planned spend exceeding our current depreciation levels. And our working capital, no structural change and stable conversion of EBITDA to cash. And as Ian mentioned, in terms of the change of moving to much more reduced inventories in our store, we have seen a significant reduction of over 6.5 million inventory over the last 18 months as we've changed that business model. And then from a net debt perspective, targeted to be maintained below 2 times EBITDA in the short term, and in the medium term, a net cash positive position, excluding any future strategic spend. In terms of Unbound, as Ian outlined there, we have a clear 3-phase approach to the Unbound strategy, which will initially involve us adding digital partnerships, leveraging and developing the Hotter digital platform. The framework in place will be a partnership model selling on the Unbound side. We expect first revenues from H1 calendar year 2022, so the first half of next year. And our profit generated from these non-Hotter revenues targeted around 25% in 3 years, building to 50% over the 5 years. Our partnerships will be EBITDA and cash generated from the outset, with reinvestment of growth in the short term. And as Ian said, no investment required inventory in the short to medium term. The working capital model, we will not need to invest in here as we're selling through our partners. And then finally, in terms of the capital expenditure, similar levels to Hotter in the 2.5 to 3 million, as we build on the existing Hotter platform and stabilise at that point. There's no dividend policy plan in the medium term, as we focus on capital appreciation. And again, from a net debt perspective, targeted to be below 2 times EBITDA in the short term, and again with a medium term net cash position without excluding any further strategic spend. So I'll just pass you over to Ian just to conclude the presentation.
Great, thanks, Dan. So I think hopefully what you can see here is, the Hotter business is now digitally focused. It's very clear. We've been through a turnaround process. We've got deep penetration within our database. The financial guidance that you've just seen from Dan is exactly the same as the 15th September CMD presentation, with some significant macro tailwinds. I think there's huge opportunity in this model to become a true specialist in this demographic, with new partnerships that we're putting in place to serve this demographic. And the medium-term ambition to generate over 50% of EBIT from non-Hotter products remains the same. And we've changed this company significantly over the last 2.5 years now. We've got a very focused team. We've got an award-winning digital team. We recently won the best e-commerce operation at the Drapers Awards that we're very, very proud of. And the leadership team is in place and motivated to go and execute against this Unbound strategy that we've put in place. So with that said, I'm very happy to take your questions, or we are very happy to take your questions.
That's great, Ian, Gavin, Dan, thank you very much indeed for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab on the right-hand corner of your screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. We'll send you an email when that's ready for your review. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation's ended, we'll redirect you for the opportunity to provide your thoughts and expectations directly back to the company. Ian, Gavin, Dan, obviously we received a number of questions ahead of today's event from investors, which you have very kindly provided some written responses to, which we will publish shortly after the meeting. But of course, you've had a number of questions submitted by investors during the meeting itself. So I wondered, if I may, could I hand back to you just to read out the questions and where appropriate to give a response, and then I'll pick up from you at the end.
Cool. Okay, so I'll take the first one, I think. What is the current situation with the supply chain issues that you mentioned? Have you increased your inventory to ensure supply? I think the current situation, as with the whole world supply chain, is when you turn something off, it's very easy. When you try to turn it back on again, that's where you have the challenges. So we source a number of components from predominantly Southeast Asia, and we final assemble here in Skelmersdale. So we are the largest shoe manufacturer. But those components predominantly come from India and the Indian subcontinent. So we are supply has been consistent over the last few weeks. But what we're seeing is it's quite difficult to get those products out. So building inventory is not something that's possible at this time. What we are doing is we're ensuring that the inventory that we've got incoming, we've got a very efficient factory here in Skelmersdale. We can turn an upper or the top part of a shoe into a finished pair of goods within 48 hours of receipt and out to the consumer. And I think that's where we've been very fortunate to be able to have this facility during this period. So we continue to see some problems in the supply chain, but I think we're managing it very effectively. If I go to the second question, I am going to pass that over to Dan or Gavin. Please explain what parameters are involved in assessing the 0 to 15 million COVID insurance claim.
Maybe I could pick that one up initially.
Gavin, I think we may be losing your connectivity slightly. Perhaps, Ian, I could hand to you to hand over to Dan.
Obviously, we're going through a live process, so we can't share anything for obvious reasons in terms of that. And in terms of obviously our position, we feel very strong. We've got a clear case regarding that. In terms of the parameters from 0 to 15, like any legal case, there is obviously the potential for 0. However, we feel we've got a very strong position on that, and unfortunately, I can't share anything too much further than that. But we've obviously got significant substantive evidence behind the position that we feel is reasonable for us. Okay.
Do you want to keep going, Dan?
Yeah,
I think the next question.
So just regarding the EBITDA margins, so essentially this is just what we showed there, excluding the head office.
You might just want to read the question.
So sorry, apologies. Yeah, so if EBITDA margins for direct to consumer are 27%, accounts for 74% wire group EBITDA margins 25%. And that's all. So it's related to our head office costs. So largely our staff costs, as well as some of the general costs as well. We wanted to show the channel position there, which is how we allocate our costs.
Maybe I'll take the next one. What research have you done in relation to the socio-economic groups that your existing customers come from? I think extensive. So we use Mosaic quite heavily here. Think of that currently breaks it down into 47 different target groups where we segment our complete database. So we do that. We're also at a geo-targeting level as well. So we have some quite sophisticated tools that we use in house, and we've really expanded and beefed up our digital group who are executing against those trends in the business. So I think that's one area that we are very, very strong in. So can you please explain a little deeper which are the barriers to entry and the competitive advantages you prevent, at least make it difficult for potential competitors to copy your business model? Well, I think the key area. So anybody could go and do what we're doing. I think that the bit they can't copy is that we are a specialist in comfort. So our DNA is in the technology around comfort. I think we've been doing this for 60 years or 62 years. What they can't copy is 4.6 million people in our database who've had very strong positive relationship with Hotter. If you look at our net promoter scores, they're very, very strong. So we've got a very loyal consumer base. If you look at our VIP customers, it's amazing the amount of shoes they buy from us on an annual basis. So I think it's very, very difficult to replicate that. The other thing that is a key competitive advantage that we're driving through, though, is this is going to be a curation. This is not going to be a marketplace where we get a collection of brands and throw them against the wall and see which ones stick. This is a hand-picked curation based on the unique insight we have through those transactions we've had with those 4.6 million consumers. So I think that's the crux of it. And because we are a specialist in this age group, again, if you start to look around the market and try and highlight a core specialist in this 55 plus market, I think it'd be quite tricky to come up with a comparable business model as it stands today. And I think that hopefully that answers the question. Dan, do you want to take the next one?
So how brand product sales go in terms of cash collection of commission products and dispatching returns. So in terms of, we have agreements in place, and this is where we're selling obviously hotter products through other digital partnerships. Regarding terms, I can't go into the commercially sensitive in terms of that. We dispatch and deal with the returns on that. From an Unbound perspective, because it's not launched as yet, it will be the reverse from that from a model perspective. So next question from Mike, just regarding equity exposure. We will pick that one as part of the Q&A in terms of what we published, which is related to the equity exposure that management has. And just scrolling down.
How much we're going to spend? Sorry, great job on hotter focus. Thank you very much. Opportunity and risk for Unbound. Can you please be clear on how much will be spent on this opportunity by year? I think that's for you, Dan.
Yeah, absolutely. So in terms of that, like I say, the beauty of this as a model is that we don't have to invest in working capital. And from a capital expenditure perspective, our investment is essentially around the Unbound website, of which we'll be leveraging the hotter technology that we have in place. So the capital investment, again, there is a benefit there, but we do not have significant drains on initial working capital, as it is a commission-based model once we're up and running, hence why it will be positive from a cash generation from the outset. We do not have significant ongoing costs as a result of bringing the Unbound proposition to life.
I'll take the next one. What are the plans for store openings? I assume digital is focus, spot on. I think though, if I just go back to the chart in the deck, I think there is an opportunity to open not what I would call stores, our inventoryless technology centers, where we can scan people's feet, get their digital data, but also ship products to them. We've got a very nice garden center concession model, which we've just opened a new one, our 7th, which is with the Not Cuts group in Nottingham, in a place called Wheatcroft in Nottingham, and we've been thrilled by the first 4 weeks of trading there. But again, with virtually zero inventory in the store, so I think that could be the model moving forward, and we've already got the technology to be able to do it. So I think again, low working capital driving to digital. So I think you're spot on, Michael, with what you said. Next one is for Gavin, I think.
A question: were you happy with the way that the demerger of the business, I think referring to Hostmore, was handled, and with the cost? Why do you think there's been such a sharp fall in the share price? Well, I suppose there's more than one aspect to that question. I mean, we were happy with the way that the demerger was concluded in the respect of getting the transaction done. We believe that it leaves a very strong Hostmore business, very well capitalized business with a good, excellent management team and a good plan for value creation going forward. So I think in terms of completing a successful demerger, we were happy with that. In terms of the costs of the demerger, they were not insignificant. However, the published costs of the demerger were to quite a high degree contingent on the market capitalization of the business going forward. At current, now clearly, the current market capitalization of Hostmore is not what we would hope it would be going forward. At these levels, the transaction fees are materially less than the figure that you may have picked up from the prospectus. Clearly, there's an incentive for the investment banks and the advisors to ensure that the market capitalization increases over the period of measurement in relation to their fees. Why do I think that the share price of Hostmore is where it is at the moment? I think, as I mentioned earlier, I think it's significantly influenced by the extremely negative forward-looking statement that the restaurant group issued in middle of September. Their share price fell 35% following that, and I think that, and whilst a lot of the forward pressures that were highlighted in that statement, we don't believe are relevant to the Hostmore model. Nonetheless, that has put some sentiment against the sector, and given that there have been a relatively small amount of particularly retail sellers of Hostmore post demerger, with only really one institutional seller of any scale, but in the context of a negative outlook on the sector generally, that has reduced the opportunity for buying. I think the level of the share price at the moment makes it a very attractive stock, and we are starting to see significant buying activity come in. So I think that will recover, and we are extremely confident that Hostmore will generate significant value for shareholders going forward. Clearly, the same applies to the ELECTRA share price has fallen, I think, since the demerger. I think that's a different situation. I think there, and it probably ties in a little bit to one of the subsequent questions that we'll just come to. But I think the clarity of the business plan for Hotter going forward, the clarity of the Unbound strategy going forward, is less well known. Hopefully today we'll go some way to addressing that. And I think also the clarity of the other assets in the balance sheet will hopefully help in that. The other question I mentioned, ELT is now mostly Hotter, but there are other elements like cash and listing fees to come. Can we assume that these balance themselves out? Hopefully we gave some in slide, I think 7 it was, so 7 and 8, which were the valuations. Hopefully we gave some clarity of the assets that are in ELECTRA other than Hotter. We anticipate that these slides reference 8.2 million of cash that was in the ELECTRA balance sheet as at the end of September. We have also referenced that as part of the pre-listing process, we're going to reduce the gross debt of Hotter by 5 million. And as you indicate, there'll be some fees and other things, but equally there are some of the other assets that we're going to turn into cash in advance of the process. So broadly speaking, I would say they don't balance out. I think there'll be a positive cash balance left in ELECTRA as it transitions into Unbound, and we anticipate that the overall group net debt at the point of transition will be of the order of 3 to 6 million.
Ian, just to pick up your question on the specific of the Unbound investment. So I've indicated in the guidance that our capital expenditure with the first year is sort of 2.5 to 3 million. Not only that will be required to go live. So just to be clear in terms of your question, ongoing from that, in a very doomsday scenario, which we obviously don't believe, there will be no significant ongoing costs associated with that. So it would just be the capital investment required to get the actual site live in itself. I hope that addresses your question.
Ian, I might just jump in, seeing as you've answered every single question that has come in from investors. So firstly, thank you to everybody that's taken the time to submit questions. And as I said, those pre-submitted questions will also be published for everybody to review. Ian, I know, and Gavin and Dan, I know investor feedback is important to you, and I will shortly redirect investors to give you their thoughts and expectations. But before doing so, I just wondered if I could ask you for a few closing comments just to wrap up with.
No, great. Thanks a lot, Mark. Hey, I think this has been a great opportunity to be able to talk directly to you this morning, and hopefully we've given a little bit more colour on our plans for Unbound, and you can start and see how this is going to be a very exciting opportunity as we move forward. I think we've got a great base now in the Hotter business. I'm very excited to be staying and leading this business into the future. And as Gavin alluded to right at the beginning, we think there's value in the stock currently. We have much larger aspirations to take the stock to a very different place. And appreciate your time this morning, and I've really enjoyed it actually. So looking forward to doing it again soon and taking more questions from you. So thank you very much. Gavin, anything you want to add? Or
no, I think that summarised it very nicely. Thank you.
That's
great.
Perfect. Ian,
Thanks so much.
No problem. Ian, Dan, Gavin, thank you very much indeed for your presentation and for updating investors this morning. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of ELECTRA Private Equity PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Good morning to you all, and thank you once again.